Okay, so now we're ready to recognize the interest in the joint venture, and we're working on the basis that the venturers themselves are both leaving their assets at cost. There's no revaluation of the proportion or the stake that they keep. So the entries, we'll just lay out the entries first and then we'll work through how we've got to them. So the first thing is, with the land and the equipment, you credit land and you credit equipment, or indeed credit any asset that's put in, the amount which is on the books of the venturer. So for the land, even though its fair value was $180,000, its carrying value was $80,000, so that's what you credit. Same deal with equipment. Even though it was at 120, its carrying value was 100, and that's what gets credited. Now, I've made a simplification with equipment, as if there was any accumulated depreciation, I've netted that out. If there was accumulated depreciation, you'd debit accumulated depreciation in this entry as well. The next step is to work out the gain on sale on each of the assets put in. So for asset A, or for venture A, the land, it had a gain of sale of $40,000, and for venture B, it had a gain of sale of $12,000. The debit interest in joint venture is then the balancing amount for both of them, which is $120,000 for venture A and $112,000 for venture B. Now, the way we got to all of this was to basically say, and we'll focus on A here, is that A had a 60% share in this joint venture, which meant it effectively sold 40% of its assets into the joint venture. Now, the land originally had a fair value of 180. Take away its carrying value of 80 gives you a total gain of 100. Now, if A had sold 100% of this asset, then it would recognize a $100,000 gain. However, it only sold a 40% proportion of it, and 40% of $100,000 is the $40,000 that you see here, and these two add up to the balancing amount of 120. B, much the same thing happens. It has sold, 60%, and the gain was overall $20,000, which is 120 minus $100,000 carrying, times by 60% gives you $12,000, which is what you see up